When Alibaba reported their Q2 earnings, it was like a bomb went off. The shares crashed and some people even started commenting that Alibaba is done and JD.com is the new king. As we went through in part 1 of this 3-part series on Alibaba's results, the underperformance in China commerce was weaker than expected, but it was not devastating. And a lot of it was largely modeled out to the point where my valuation did not materially change at all. In this video, we're going to go over some of the items that few people are talking about, which are the shining lights in the Alibaba portfolio, their cloud computing business, and international commerce business. You're watching More Money, let's get it. Guys, and let's start with the cloud business. Cloud continues to blow the results out of the water. On a quarter-over-quarter and year-to-date basis, they are up over 30%. Now, when looking at cloud's profitability, note that it took a slight hit because they reclassified DingTalk, which is their version of Zoom, into the cloud segment. And this business is still in its investment phase, so it will reduce the profitability of the segment overall. But at the moment, I'm more concerned with top-line revenue growth in this segment as opposed to achieving peak profitability at this moment. Speaking of which, what exactly is driving the growth of the revenue in the cloud business? Well, it looks like they seem to be winning with the internet, financial services, and retail industries. I don't know what the natural industry life cycle of cloud adoption would be, but I would suspect that internet companies would be the first, as they would be developing the platforms to address specific consumer use cases. So it makes sense to me that those are the industries that are taking it up first. One thing that's very interesting is that Alibaba Cloud is now beginning to utilize its Yitian 710 custom-built chip, which has been stated by Chinese internet watch websites as a combination of exceptional performance with energy efficiency. I am not a microchip expert, so I'll have to take their word for it, but what I can understand here is that they also released their cloud-focused operating system, Anolis, and simultaneously announced its open source. So Alibaba is doing here what they do best. They are all in on building out an ecosystem specifically targeted at the development of cloud-native applications, namely programs that are designed for a cloud computing architecture. I personally believe that as this ecosystem scales up, they're going to enter into a virtuous cycle of higher and higher revenues and profits in the cloud business. So I can easily see this segment continue to grow at a high rate while simultaneously becoming more and more profitable as it realizes further economies of scale. And you can see that the segment has achieved profitability and remains profitable into the second quarter. Compare that with Google Cloud, a similar sized competitor, which has not yet been able to achieve profitability. Overall, I'm super excited about this business, but I do have to point out that as exciting as the future is, it takes time to develop. So you can see here in my model, I'm not forecasting the revenue growth out at the same rate that it has historically grown, nor am I giving them the same profitability as Amazon has been able to achieve. This is sort of my way to add a bit of conservatism here. Now, we can't talk about cloud without looking at their North American counterparts. If you thought Alibaba's cloud computing growth rate was impressive, well, they just about got smoked by all 3 of their major North American competitors. Amazon, the global leader, grew AWS at 38% in the quarter and 36% year to date. Google Cloud grew in the quarter by 45%, and Microsoft grew their Azure platform by 50%. I really have to do a better job in understanding what exactly Microsoft is doing differently to be growing at such a high rate, which I will follow up on in future videos. This is too interesting to not dig into. Now, am I concerned that the American counterparts are growing at a faster rate than Alibaba right now? Not really. It could reflect the different dynamics within the countries. Now, what's more of a concern to me is that I got to do a bit more research into China specifically, and I really got to understand the segment, which includes understanding where exactly Tencent is in this space. They are the one company that I really think poses the biggest threat to Alibaba in China right now, and you largely haven't heard much of them in this space yet. But I have to say, this is incredibly exciting, and I do believe that cloud will one day become Alibaba's largest business segment. So more to come there. Now, moving on to the international commerce business. The biggest surprise for me this year so far has been the strength in Alibaba's international operations. Overall, on a year-to-date basis, the international business combined is up 41%. And the biggest surprise is that the international commerce retail business being up 43%. To put that into perspective, this segment has had a 3-year growth rate of 35%. In my valuation, I cut the segment growth rate down to 20%, and I put a note saying that this segment could struggle as Baba is not the strongest outside their home base of China. And boy, have they proved me wrong thus far in their fiscal year 2022. One of the businesses which is an absolute surprise for me here is Lazada, which is Alibaba's Southeast Asia online commerce business. When I made my 6-part series on Alibaba, I did a bit of a scuttlebutt on the Lazada marketplace. I was not convinced that Lazada was going to be a powerhouse in the market, but Alibaba is thus far proving me wrong. They have increased their assortment of local and global product supply, which has resulted in stronger customer market share and user stickiness, as evidenced by improving user visit frequency over the last 7 consecutive quarters. They grew order volume in the last quarter alone by 82%. And an even bigger surprise to me was Trendyol, which is the largest e-commerce platform in Turkey. This business saw an 80% gross margin value growth year over year based on a constant currency. So this is absolutely amazing. But what has me worried about this business is that Turkey is in the midst of a currency crisis at the moment. As their currency continues to devalue relative to the US dollar, their imports are going to become more and more expensive, and thus they could potentially have foreign exchange related inflation. That of course could slow down the economy. I am concerned about this, but I'm also happy that the business is doing well thus far. I would not be surprised if the business does slow down as a result of further strains on the economy there. So overall, it's very good news both on the cloud front and on the international commerce business. But as described earlier, there are things that we need to watch out for. Despite the outperformance in both segments, I'm not increasing my growth expectations. Call it conservatism for now. If something changes materially in the business and I can forecast out more outperformance in the future, I'll bring up my expectations. In the final part of this series, I will go over the full model and show you exactly what's driving that $300 per share valuation. If you missed part 1 of this quarterly results series, click right here. Thank you very much, guys, and I'll see you later.